Have you ever wondered how a small tweak in interest rates can shake the real estate market? Let's dive deep. Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing the impact of interest rate changes on real estate investing. So, interest rates and the cost of debt are major factors when investing in real estate, since in most situations, real estate investors fund most of their purchases with debt. Now, when interest rates change, these changes can significantly impact real estate investors in several ways. Number one of the most obvious changes is the cost of borrowing. When interest rates increase, real estate investors need to rework their investment underwriting with a new cost of debt to see if the deal still makes sense. Now, this can be tricky with short-term holds because investors need to purchase the property initially and resell it at a profit in the future. If interest rates are increasing, they need to ensure that when their renovations are complete, the value has been added, the new buyer can actually obtain financing and purchase the property while compensating the seller to make it all worthwhile. Now, interest rates are still a factor with long-term holds. If the investor obtains long-term fixed-rate financing, say 10-year or longer loan term, and the property is currently cash flowing or very close to it with the current interest rates, this is a much lower risk investment. The investor now has 10 years to complete renovations, increase rents, correct property management, or anything else that's going wrong. And then in 10 years, the property will most likely be valued much higher than it was when it was purchased. So it can be easily refinanced, even if the interest rates are higher. Now, if interest rates drop, this is typically a benefit to the investor, since in many interest rate decreasing situations, the value of rental property increases since real estate becomes a more attractive and sought after asset class. Two, property prices. So investment property values, especially commercial real estate values, correlate heavily with interest rates. When interest rates increase, capitalization or cap rates increase as well. Now, cap rates are the expected return on a real estate investment. Typically, cap rates are higher than interest rates, and the spread is called the risk premium, which measures the demand for an asset with more risk than a treasury bond or the risk-free rate of return. Now, the lower the cap rate, the higher the price you're paying for the property. This is why you will see premium A-class properties with low cap rates and old C-class properties with higher cap rates. When cap rates increase, commercial property prices decrease. So suppose you purchase a property in a low interest rate environment, sell it in a high interest rate environment. In that case, you could sell a property for less than you initially expected to. The shorter the hold, the more important the exit cap and interest rates are to your projections. The longer the hold, the less impactful the interest rate cap or cap rate is, because you will usually add so much value to the property during that time, and it's also very difficult to predict interest rates in 1 year, let alone in 10 years. So it might not even be a factor you're figuring into your underwriting. So how do you protect yourself from interest rate increases then? Well, purchasing properties with a lot of meat on the bone is the best way. Now, a past mentor of mine said to buy only fat deals. That is, properties with dramatically undervalued rents and lots of potential. When I coach real estate investors, I say that they need to buy properties that, when renovated, can actually raise rents by 25% to 30%. I use a case study when I'm showing this in my coaching sessions, and it shows a deal that went foreclosed, and it shows that they were only raising rents by like 10%. There wasn't any meat on the bone. They were literally just trying to grab a little bit of market share and highly leverage the property, and that's why it went under. 3, investor sentiment. So rising interest rates can usually scare away potential real estate investors, since many investors are worried about higher borrowing costs and possibly lower property values in the future, which makes sense, especially if they're short-term investors. Now, decreasing interest rates usually has the opposite effect, where investors are now more confident about lower borrowing costs and possibly higher future property values. 4 is rental market dynamics. When interest rates increase, some would-be homebuyers might continue to rent instead of purchase because they might not be able to be approved for a mortgage now. And now this usually leads to higher rental demand, higher rental prices. On the other hand, falling interest rates might make property ownership possible for renters who previously could not afford a home, possibly lowering rental demand. Now, it's important to note that landlords who own Class A and Class B properties are more susceptible to losing tenants as they become homeowners. This is less of an issue with Class C and Class D landlords, since many C and D tenants lack the credit, cash, and/or income to be approved for a mortgage in the first place. 5 is refinancing opportunities and hurdles. So property owners can decrease their debt servicing costs by refinancing when interest rates drop. If they have a prepayment penalty, the interest rate savings and the prepayment penalty must be considered first before refinancing. If interest rates increase, property owners who do not need to refinance will most likely avoid doing so. However, certain investors with loan terms ending during a high interest rate environment will now be forced to refinance and pay that higher interest rate, pay off the loan with their own funds, or sell the property. Now, the impact of interest rates on real estate investing can vary greatly depending on the individual investor's strategy, the time horizon, economic environment, and the market conditions. Real estate investors need to consider all these points when investing. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.